In this video, we're going to talk about installment loans. So I'm going to focus on buying a house, but this could also go for buying a car or anything where you set up a payment plan for a specific amount of time where you know that at the end of that period of time that your item will be completely paid off. So let's look at this example here. So this example says, suppose you want to buy a house for $170,000 and you can put 20% down and you qualify for a loan at 4.6% APR. A couple things here before we jump into the math of it. This qualifying for the loan part, you have to contact a lender and figure out what you qualify for, and this is going to be based on your credit score, mostly your credit score, also your income. It's kind of a process. You got to provide your income tax returns, most people for the last 2 years, and fill out a form of all your assets. And it's not an easy thing to go through to get a loan for a house, but just take one step at a time, and if you have a good lender, they'll walk you through it step by step. Now this 20% down part, I put 20% down because you always want to shoot for 20% down. If you don't have 20% down, you're going to have to pay something called private mortgage insurance, or PMI. And that's an extra monthly payment that the lender requires of you because you don't have enough equity in your house. So if you're not putting 20% down, which you can certainly get loans where you don't have to put 20% down, make sure you ask how much my PMI is going to be. Get an estimate of the private mortgage insurance, and just be aware that you're going to have to pay for that, because 20% of the cost of a house is a lot of money. So if we look at what 20% of 170,000 is, well, let's see, 10% would be $17,000. So 20% would be $34,000. So what that means is you have to have $34,000 in cash, and that doesn't include any possible closing costs that are there. So you always ask about those as well. That's a lot of money to save to buy a house. So if you can, great. If you can't, a lot of people buy houses without putting 20% down. But in this scenario, we're going to put 20% down. So what that means is that we're going to walk in and we're going to put $34,000 on the table towards the cost of our house. So that $34,000 is going to get subtracted off the amount that we owe for the house. So now we owe, or we're going to borrow, $136,000. That's how much we need to borrow for the house. So probably the first thing you're wondering is, what's my monthly payment? How much am I going to have to pay each month? And there's a lot of different ways to figure out the monthly payment. The book that I use in my class, the book that you might be using, uses a formula to do that. Let me show you what this formula looks like. This is the formula right here, and it uses the principal, which is the amount you're borrowing, the $136,000, the interest rate, the number of years that the loan is going to be for, and the number of payments per period. So, that would be like 12 the months, right? Okay. So I don't like having students use this formula. First of all, they're not going to memorize this formula. I don't memorize this formula. And in the real world, what you do when you want to figure out what your monthly payment is you go to a website like bankrate.com. So if you're in my class, you're not going to be memorizing this formula, and you're going to be using the internet to figure out any time that you need to figure out your monthly payment, which means that on a test, you're probably not going to be asked to find the monthly payment because you're not going to be using the internet. I will just give you the monthly payment. So what you're going to do is you're going to go to bankrate.com. Anytime you want to figure out your monthly payment, you're going to scroll down a little bit here, and there's something called a mortgage calculator. So you're going to click on that. All right, so we're going to come down here. Our home price, or what we're well, we could put in all this business here. So what was our home price? $170,000. And remember, we put 20% down, which was $34,000. The interest rate we qualified for, I don't remember what it was, 4.6. Now, I didn't say the length of the loan. Let's go ahead and say this is a 30-year loan. That's most common. You could ask about a 20-year loan or a 15-year loan, and sometimes you can get a slightly lower interest rate for a 20 or a 15-year loan. but the payments are still going to be quite a bit higher, and you could fiddle with that on this website. So we're going to go 4.6%. 4.6% for 30 years. And it's calculated all out right here. Now, something I like about this website is it's super easy, and you can change any of these numbers and figure out, how much it's the rate you would need to get a certain payment, or shoot for a certain payment, how much house could you get. But one thing that's a little confusing about it is this number looks like your monthly payment. It's actually your monthly payment of your principal and interest plus any insurance plus property taxes. Now, that's a good thing to be aware of, because a lot of people think, oh, if it just came up that your loan payment's $700 or $697, you're like, oh, that's great. That's hardly anything. But remember, if you own a house, you're going to be paying homeowners insurance and property tax, and that's going to vary depending on where you live and what type of house it is and your insurer. So these numbers, this $54 and this $150, are complete estimates. But this principal and interest is the monthly payment. That is for sure, no matter what city, state you live in, whatever, that's the math, $697. So that's your monthly payment. Let's go over here and write that down before I forget it. Okay, so monthly payment, I'll call that MP. See, I forgot it already. $697. Now, we're going to go through some math with this number, but before we do that, I just want to go back to this website and show you, like, let's say you knew you could afford a monthly payment of $1,000, all right? Not including interest and property, or insurance and property tax, just this principal and interest. So you still get 4.6%. You can fiddle around with this number, make this number go up. Now see how this is changing, 948. It's right around in there. Oh, there we go. Now we're over 1,000, right? So there's about $1,000 there. So if you could put 20% down, which is 50 grand, you could afford this much house, right? Around 245,000. Maybe you can't put that much down. Maybe you change that to 10% down. 10% down. Okay, so now look what happened to your monthly payment. It's up over $1,100, so we'd have to move this down. This is how people investigate loans and monthly payments. They don't use this formula. That's not practical, okay? So that's why I'm not having you do it. Now, I want to go through step by step what happens once we start this loan. And again, we're going to go back to the website, and it's going to show us all these numbers as well, but I want you to understand where they're coming from and what's happening. A lot of people don't understand what happens with their loans, so I'm just going to divide this off here. Okay, so now we've borrowed this money. We've borrowed $136,000. We're making our monthly payment. So month one rolls around, and we send in our $697. Are they going to take away $697 from the amount we owe? No, they're not, because they want their interest. They want their interest. So what they're going to do to calculate their interest is they're going to multiply the principal, which is the amount you owe. I'm just going to abbreviate. Well, I'll write it out. You owe $136,000 times the rate. Now remember, this is an annual percentage rate. So then they would multiply that by 1/12 or divide that by 12 to get a monthly percentage rate for your monthly interest. So let's go ahead and see what that gives us here. So we have 136,000 times 0.046 divided by 12, same as multiplying by 1/12. $521.33. Okay, that's a little startling if you think about what that number means. $521.33. Let me write this down. $521.33. That's the interest that you owe your lender for month number 1. So we're going to call this next column the amount to principal. So the amount to principal is not your $697. Let me abbreviate here. Amount to principal. So they're going to take your $697 that you sent them, and they're going to take out $521.33 for themselves. Let's see what that gives us. Um, 697 take away 521.33, $175.67. That's the amount of your almost $700 that actually goes towards reducing your principal. A little startling, isn't it? So your new balance that you owe on your house, you used to owe $136,000. They're going to take off $175.67. Let's see if I can do this in my head. 1, 3, 4, 8 to 4.33. Is that right? No, wait. That should be 135, right? Because we didn't pay $1,000. All right, let me fix that. You can use your calculators. You don't mess up like I just did there. All right, 135. So we owe 135,000, right? Yeah, we didn't pay over $1,000. So now, after 1 month, remember we're going to do this for 30 years. After 1 month of paying, we still owe $135,824.33. But don't get too discouraged. It gets a little bit better. Next month, so this was month number 1. This was month number 1. Month number 2, next month, when they calculate your interest, well, you only owe $135,824.33. And we're going to multiply that by the interest rate divided by 12. Let's see what that is. It's going to be a little less interest, right? Because the balance that you owe is less. The number you're multiplying by the percentage is less. Probably not too much less, though. Divide by 12. What do we get? 520.66. 520.66. A little less interest. So you're still going to send in your $697, but this time they're only going to take away $520.66. So that means you're going to get $176.34. That's going to go towards reducing your balance. So it's a little bit more of the $697 that you sent in. So now your new balance, we're going to subtract off I'm supposed to be getting color coordinated here. Keep purple. Subtract off 176.34. 176. I could probably do this in my head, but it's too much pressure. It's too much pressure on the video. 135,824.33 minus 176.34. What do we got? Now I got to remember this. 135,647.99. I'll just put it here, then I can still see it. Oh, 1/3. No, I can't see it. I didn't move it far enough. 135,647.99. 135,647. Okay, so that's our new balance now after 2 payments. Whew. We only have how many payments left? Well, our total number of payments, we're doing this for 30 years, and 12 times a year, we have 360 payments to make. We've made 2. All right, we've only got 358 payments left to go. Now, if we kept doing this process and made this table, this is called an amortization table. I think there's an I in there. Amortization table. Let's see if wait, let's go over here. There it is. Okay. All right. There's no I there. Let's take that out of there. Let's spell it right, shall we? Amortization table. And what this means is when you talk about amortizing a loan, it means breaking it down month by month and showing exactly what happens. So let's go back to this website and put all this information back where it was. So we had the 170,000, and then we had a 20% down payment, 30 years, 4.6%, 697. All right, so now here they're calling it a schedule. So if we click on this and we scroll down, we see Let me see if I could show both these things here. Yeah, we don't care about the dates. They're picking an arbitrary date there. All right, so here's your payment. Notice that payment's staying the same. This is month by month. I moved it off the screen, but they're just picking months based on, since we just did this today, giving you the future dates. So the principal amount, 175.67, we've got that. 176.34. Then the amount that's interest, we've got those over here, and the balance. Sometimes you might get off by a penny. We've only done 2 months here, but you can see that what we have right here, this number, is the same as what they have right here, right? The 135. So if we kept going and going, we would get all these numbers. I want you to know where these numbers come from so you could see what your balance. Maybe you think to yourself, you know what, we're going to stay in this house for 10 years and then we're going to plan on selling it. That's the plan. How much are we going to owe in 10 years? Well, you could scroll down your amortization table to 2029. Let's see if we can, there we go. 2029, we're going to owe $109,000. So maybe the value of the house will go up and we can sell it, and then we got to pay off the $109,000. But this schedule will go all the way. Here's your balance. This is what you owe. It's going to go all the way till the end of the loan. I'm scrolling off my page here. Till you owe $0. Okay. Now, something I want you to recognize here is as the loan goes on, what happens to the amount of interest that you're paying? We saw it in the first two that it went down by $1, but notice, you know, it keeps going down, keeps going down. Let's go back ahead like 10 years into the future. It's going to take till 2031 until these are getting close to being equal. All right? It's going to take a long time. If you go to the very bottom of this thing, it's going to show you how much interest that you've paid. It's going to add up all your interest payments. And I'm going to show you another way to do that without having to do the amortization table. So let's see, this was your interest column right here because it's nothing at the end of the loan. This is the very last payment in 2049. You will have paid $115,000 in interest, about $136,000 towards your principal, and your total amount of your payment is $251,000. All right, this is interesting because remember, this should be exactly $136,000. That's what we borrowed, $136,000 right there. But it's off by 90 cents. So there's rounding that's happening in there. You will end up paying all of it back. You'll have to pay that 90 cents. But whatever program this is using to calculate this table has lost 90 cents somewhere in these 360 payments, which is understandable. All right, I want to show you now how you could find the interest on this guy without going through the whole table. All right, so let's clear out some of this stuff. All right, so now we paid $697. Let's say we pay this off till the end of the loan, which honestly most people don't do. Most people don't live in their house for 30 years, so you need to think about that. But if you paid this payment right here for 30 years times 30 years and 12 months a year, we could figure out how much you end up paying back by simply calculating that. If I give the bank $697 every month for 30 years, I'm going to end up giving the bank, let me do that one more time. I feel like I might have, times 30 times 12. Okay, $250,920. $250,900. That's how much you ended giving the bank in all your payments. Now remember, you were borrowing $136,000. That's how much you borrowed. So we would subtract those, and the extra would be the interest. So that would be what, $113,100? No, sorry, $100. $920. Well, I wonder how close that is to that schedule from that website. Let's go. Let's go see. 130. Did I do that right? That looks good. Did I do that right? Let's see. If we add it back together, that's only going to come to a 9. So we need a 4 there, don't we? Okay. 114. That seems like more than what the bankrate.com thing said. No, they had 115,000. I wonder if this monthly payment that they're telling us is rounded to the nearest dollar. Let's go back up here. Payment breakdown. Because there's probably some cents in there. Instead of 697 exactly, it might be 696 point something something. I'd be surprised if it came out to exactly this number. But there are other websites if you needed to get down to the nearest penny. I think you get the idea that you're paying a lot of interest. This number is pretty startling to people right out of the gate when you first learn about it. But you can really make a difference if you send in extra money. Okay, so right here, when we went through this schedule, we were sending in our payment of $697. But you don't have to pay $697. That's your minimum payment. What if you sent in an extra 200 bucks every month? All right, if you sent in an extra 200 bucks every month, then that's going to get taken right off this number here. So we would subtract off the 175, but we'd also subtract off another 200, and then we'd subtract off another 200, and these numbers would be different, right? And these numbers would be smaller, which would make our interest smaller because you're using that balance to calculate the interest. And there's a lot of websites that will allow you to put in extra payments. I don't think this Bankrate one does, but if you can say, well, what if I add an extra payment of $200? How would that affect how much time it would take me to pay off my loan? And I don't work very much in the summer, and I work more during the year. So during the year, I send in an extra $400 a month for my mortgage payment, and then during the summer, I back it off and pay the minimum payment. Just any little bit that you can send in on any type of installment loan is really going to affect the amount of overall interest that you have to pay on your loan. Well, I hope that helped, and I hope you can kind of see how these loans work, and also the tools that are available to you online in order to help you see how much you can afford and how that money is broken down.